Today, I'll be breaking down Tesla's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Tesla's growth trajectory has been nothing short of extraordinary. Over the past decade, the company has catapulted its revenue by an astounding 2,937.5%, achieving an impressive annual growth rate of 40.7%. Net income has also seen a significant transformation, shifting from substantial losses to a profit of $12.7 billion over the last 12 months. However, it's noteworthy that Tesla's profit declined by 15% over the past year as 2023 revenues neared $15 billion. Free cash flow presents a more nuanced picture. While Tesla has achieved profitability in this area, the current free cash flow stands at $1.7 billion, which is notably lower than the net income of $12.7 billion. The big difference between Tesla's net income and free cash flow comes down to its heavy growth investments. Tesla is spending heavily on building factories, developing new models, and expanding its charging network. These costs don't show up on the income statement, which calculates net income, but they do reduce free cash flow in the cash flow statement. Tesla's growth is built on 3 key pillars: relentless innovation, global expansion, and diversification into energy solutions. Game-changing models like the Cybertruck and advancements in battery technology have cemented Tesla's leadership in the EV market. Its strategic push into Europe and China, supported by gigafactories, has unlocked new revenue streams and reduced costs. Beyond vehicles, products like the Powerwall and Megapack have opened lucrative markets in renewable energy, diversifying Tesla's revenue base. While Tesla's current growth pillars are impressive, the potential growth from its emerging technologies could be even more transformative. Tesla's advancements in artificial intelligence and full self-driving technology aim to revolutionize transportation, potentially turning every Tesla vehicle into a revenue-generating robotaxi. The Optimus humanoid robot, designed for tasks in factories and beyond, could redefine labor efficiency and productivity. Meanwhile, concepts like the Cybercab, a futuristic autonomous ride-sharing vehicle, hint at Tesla's ambitions to dominate the mobility as a service market. Together, these innovations represent untapped growth engines that could further solidify Tesla's position as a leader not only in the EV space but also in cutting-edge technology sectors. However, growth has been impacted by a slowing pace of demand in key markets, intensified by Tesla's need to cut prices to stimulate sales. Rising competition from established automakers and new EV entrants has made it harder for Tesla to maintain its dominance, particularly in regions like Europe and China. Additionally, production ramp-ups for new models like the Cybertruck have faced delays, slowing the introduction of fresh revenue streams. Supply chain challenges and a constrained capacity for certain critical components have also limited Tesla's ability to scale as quickly as anticipated. While Tesla's growth remains robust, overcoming these hurdles will be essential to sustaining its upward trajectory. If Tesla's growth has you as charged up as a fully loaded Powerwall, hit that like button. Now, let's shift gears to profitability dimension. Tesla has averaged a 21.4% gross margin over the past decade, currently standing at 18.2%. While this marks a decline from its previous highs, it still outperforms the auto manufacturing industry's average gross margin of 13.4%, showcasing Tesla's operational efficiency. Tesla's operating margin has seen a dramatic turnaround, currently at 7.8%, a huge improvement from the negative figures of just a few years ago. However, it's a significant drop from the peak of 16.8% in 2022. So, what's behind this decline? The free cash flow margin tells a similar story, averaging minus 13.2% over the past decade but improving to 1.8% today. Yet, this too has fallen from its 2022 peak of 7.4%, reflecting challenges in maintaining recent profitability highs. The decrease in profitability over the past few years can be attributed to several factors. Tesla has implemented price cuts across its vehicle lineup to boost demand and stay competitive, which has compressed margins. Additionally, rising production costs due to global supply chain disruptions and inflation have weighed heavily on profits. Increased competition in the EV space has also pressured Tesla to remain aggressive on pricing, further impacting its profitability. Moving on to the solvency dimension. Tesla's debt-to-equity ratio stands out at an impressive 0.11, a significant improvement from its 10-year average of 1.33. This exceptionally low leverage underscores Tesla's minimal reliance on debt to finance its operations. Equally notable is its net debt-to-EBITDA ratio, which sits at -0.76. This indicates that Tesla's cash reserves not only cover its debt obligations but actually exceed them, reflecting a strong financial position and robust liquidity. Now the important fourth dimension, Valuation. Tesla's current enterprise value to sales multiple stands at 10.7x, exceeding its 10-year average of 8.9x, which could signal potential overvaluation. Meanwhile, the price to free cash flow multiple is an eye-popping 619x, reflecting an extremely high valuation. Lastly, the price to earnings ratio sits at 83x. While this is a premium valuation, it remains relatively reasonable given Tesla's impressive growth trajectory. Following Donald Trump's recent election victory, Tesla's stock experienced a significant surge, with shares rising more than 30% since Trump's win. This rally is attributed to investor optimism regarding potential policy shifts under the new administration that could benefit Tesla, such as reduced regulations and favorable tax policies. Additionally, Elon Musk's support for Trump during the campaign has led to speculation about a closer relationship between Tesla and the federal government, further boosting investor confidence. The fifth and last dimension is the shareholders' return. Since Tesla doesn't pay a dividend, the metrics dividend growth, dividend yield and payout ratio are naturally rated 1. The number of shares outstanding has increased at an average annual rate of 3.4% over the past 5 years, resulting in considerable investor dilution. That said, it's hard to imagine Tesla investors losing sleep over it, given the company's growth trajectory. Currently, Tesla isn't engaging in buybacks, but its issuance rate has stabilized, helping to mitigate further dilution, a crucial metric that warrants close attention. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.1. Now let's move on to Tesla's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Tesla's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case gives Tesla a fair value of $168, suggesting it's overvalued by 49.1%. In the bull case, Tesla could reach a fair value of $444, indicating a potential 34.5% upside. Meanwhile, the bear case values the stock at $38, showing a severe downside. On average, Tesla's DCF valuation points to a fair value of $197, implying a 40.2% overvaluation compared to the current price. Based on my 5 dimensions framework, Tesla receives a final rating of 3.1 out of 5. While its growth and solvency metrics are strong, its valuation suggests the stock might be priced for perfection. Despite its premium valuation, Tesla remains an outstanding business, driven by relentless innovation, strong brand recognition, and a diversified revenue base across EVs, energy storage, and solar solutions. The company's pipeline is packed with high-potential projects, including advancements in AI, full self-driving technology, the Optimus robot, and new vehicle models like the Cybertruck and Cybercab, which could unlock significant future growth. Given these factors, the potential for Tesla to surpass current growth expectations is substantial. In conclusion, Tesla's current valuation might raise some eyebrows, but its innovative pipeline and future growth potential can't be ignored. That's why I'm diving deeper in Analysis 2.0 to assess if the stock is truly worth the premium or if there's even more upside than meets the eye. If you're as curious as I am to see where Tesla's headed, make sure to like, subscribe, and hit that notification bell so you don't miss the next deep dive. And hey, drop a comment below. Are you bullish or bearish on Tesla's future? Let's get the conversation rolling.